I like I like these stocks momentums and I like these stock names. So yeah, certainly. Yeah.
Definitely, definitely. Okay, so Microsoft's a buy.
Yeah.
One, two, three, four.
All opinions expressed by Chris, Michael, Zach, and their castmates are solely their own opinions and do not reflect the opinion of 5i Research. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Okay, welcome to the second episode of The Exponent with 5i Research. My name's Chris. I'm a senior investment analyst with 5i, and today I'm joined by my co-host Zach. Zach, do you want to introduce yourself to everyone?
Yeah, for sure. Thanks for having me on, Chris. I'm a junior investment analyst at 5i. I started pretty recently in November, and yeah, graduated university from Wilfrid Laurier in August. So getting started at 5i and been great so far. Got to look at a lot of companies and think I joined at a really interesting time. So yeah, so far been great and happy to join the podcast today.
That's great. Yeah, no, glad to have you as my co-host today. And I think that's absolutely true that you joined at an interesting time. I mean, we're seeing AI come into the forefront, lots of cool industry narratives. The markets have been moving higher, so that's always a good time. And yeah, we'll see what the market has in store for 2024. As an intro to the exponent with 5i Research, you know, we want to welcome you to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. So with that said, let's dive into the Canadian and US financial landscape. So Zach, what's the one small cap name that you have in mind?
Yeah, so the small cap name that I wanted to talk about today was Payfare. So they're a small Canadian fintech company, and they IPO'd back in March 2021. So pretty new company on the market, and they came in at a price of about $6 at IPO. And things have been pretty flat since then. Pretty volatile as well in the last year, but momentum's been strong in the last few months. It's up about like 36% in the last year, and last I checked, it was trading at about $7.39. So doing pretty good recently. And at 5i, we've had a lot of attention from Payfare, like from our subscribers. So thought I'd shed some more light on it today. Yeah, so small cap name, market cap is 354 million about, and its forward P is 12 times. So looks pretty decent from a valuation standpoint and still a pretty small company. But to get into a bit of what they do is they provide instant payout and digital banking solutions to gig economy workers all across North America, so Canada, the US, and Mexico. And a lot of Payfare's, customers are food delivery drivers and those Uber drivers, Uber Eats drivers, and DoorDash drivers. And the company actually has those companies onboarded with them. So Uber, DoorDash, and Lyft are some of Payfare's top customers. So they have some big names already onboarded. And essentially, what the business does is help workers get access to their money instantly and in a more efficient manner. So for some of these workers, when I was doing some research on and through their recent statements that they put out, they have like an issue for those workers with getting their money directly, and they operate typically paycheck to paycheck. So what Payfare does is sort of remove the waiting time that direct deposits have with when they hit your account, and they allow instant payouts. So if I'm an Uber driver and I make a trip, the I'll get the money immediately after. So that's a huge benefit of Payfare. And just to look at their revenue model here. So they generate about 70 to 80% of their money from network and interchange fees. And then the other 20 to 30% is from just user banking fees and ATM withdrawals. Looking at it fundamentally now with the charts that we got on the screen here, looks pretty good in terms of revenue growing, and margins are also coming up. But in terms of growth, it's nothing crazy, I would say. Like revenues increasing nicely and margins, they're getting better. But I thought at a, like 6% net income margin, it wasn't anything that like jumped off the page when I was looking at it, especially being a fintech company. I think would want to see it a little higher, but I also thought that, they're tied to user base. And just in the next slide here, we can see how their active users have been growing. So definitely growing pretty nicely. But I think as those users grow, hopefully their margins will improve a bit too. But having some of those big name companies like Uber and Lyft already using Payfare is really interesting. And that's why, it's gotten a lot of attention recently. So that's the small cap name I wanted to touch on there.
Nice. Yeah, no, that's awesome. This is a really interesting name, and you're right, it has been gaining some traction recently, and always love to see when one of these small Canadian stocks come to the forefront of the market and start gaining attention and investors' attention. And I especially love that recent chart that you just showed because it really displayed nicely like the expansion in margins. So yeah, really solid name there. So for my small cap name, I'm talking about EQB. That the ticker is EQB. So they're a Canadian challenger bank which offer digital-only alternatives. They've done a really great job of becoming a cloud-based business. So they offer personal and commercial banking services. And surprisingly, it's actually the leading alternative mortgage lender in Canada. They have a really strong credit quality of loans and they continue to expand their services. What we're seeing as a fundamental driver for this company is its expansion in net loans and net interest margins. And it also trades at a low valuation. So it's trading at like 8 times forward PE right now, which is quite low, even considering that it's in the financial space. And it has a really strong dividend growth rate. This company focuses its mortgages on areas with a liquid real estate market. So it's focusing on areas that, are going to perform well over a long term, and it's not taking that short term kind of growth mindset. Um, and strong growth is really expected for its conventional loans. Overall, this is a company and a bank which has a strong digital first and tech forward business model. And something that's been driving its share price recently is it actually just completed the acquisition of 75% interest in ACM Advisors. So this is one of Canada's largest alternative asset managers. They have about $5 billion in assets under management, or AUM. And so ACM specializes in the creation, structuring, and management of pooled Canadian commercial mortgage funds. Um, and so EQB is expecting this acquisition to contribute to a meaningful increase in its fee-based revenue, and it should help EQB achieve its long-term target of 15% to 17% ROE, which it's around right now as well. It's around that 15% ROE kind of range. And then I'll just briefly talk about its fundamentals here. So in the top bar graph, we have its net profit margin over the last 12 months, and we're looking at a 5-year time frame here. And we can see that its net profit margins have been really recovering from a low in early 2023 and bouncing back nicely. And this has really helped to drive growth and some fundamental expansion in the company and drive its share price higher. We're looking at revenue growth in that middle area graph. We can see its sales growth is tremendously strong, growing 40% over the past year. And then in the bottom, kind of the dot plot, that's its earnings beat or misses, so each quarter. And so we can see most of the green dots, that indicates that it beat earnings expectations. And we can see that it's been really consistent at beating earnings expectations and also at driving those earnings higher over time. So all of those kind of fundamental drivers have helped grow the share price, and also, just being a competitor to some of these larger banks in Canada. I think it's really important, and it's also good for investors to kind of gain some sort of diversification within the financial sector, but outside of the traditional large big six banks. So it's a really interesting name, small cap, and it's performed really well recently.
Yeah, that's a super interesting name. Do you think that, like competing with the big five banks, do you think there'll be more competitors like EQB, like coming into that market and trying to challenge those big names? Because I know in Canada, like we're mainly dominated by those five large players. But do you think like more we can see more EQBs trying to come into that space?
Yeah, it's a good question. I think with EQB being that digital forward, digital first kind of business model, what they're doing is they're able to kind of leapfrog these banks, which are operating on, legacy systems. They have such a large scale and large volume of business that it's really hard for them to just get to the forefront of technology and digitalization. So it's interesting because you might have some smaller player like EQB that can easily just digitize its entire, business services and then just gain customers because of that. Next up, we're doing investment tips and education. Um, so Zach, I think you have, a an investment tip or piece of wisdom for our listeners here.
Yeah, I did. So, I just wanted to touch a little bit on using different order methods when trading stocks. So, I think with a lot of retail investors that we deal with at 5i, they know that there's a lot of different order types that you can use, like, market orders and limit orders. But I actually wanted to touch on just and look a little bit more into those because I think it can be overlooked when you're learning about investing. And like me personally, just like coming out of university, I feel like it didn't get talked about, how important it is and how you can protect yourself from certain risks by using different types of order methods. So there's many, many types of orders that you could place, but I think I'm going to focus on market and limit here because they're the most common and probably the most used as well. So market orders are typically when you're just buying and selling a stock at the market price and guarantees that execution of your order. And then with a limit order, you're buying and selling the same again, but you get to specify the price that you want to pay or you want to sell at. So the interesting aspect that I found between like deciding to use a market or a limit order and that I wanted to focus on here is with timing and the concept of slippage. So it happens when you have a limit order and executes, but the price you want to buy or sell at comes in unfavorably to what you set the limit at. And when you hear that, you might think like that just defeats the whole purpose of a limit order. But I just wanted to explain why that may happen. And the main reason is just because if you're trading a stock where prices are moving really quickly and it's a volatile market, you may not get that exact price that you set your limit at. So, for an example, if you put in a limit sell order at $35 and the price of that stock is falling really rapid, your order may get triggered. But between the time your order gets triggered and executed, the market price may be $34. So your order may be filled below that initial limit that you set at. And typically it's not going to be a dollar difference like that. It may be like a few cents. But I did think it's an interesting concept, and the way that you can sort of mitigate that, it actually gets pretty interesting with placing orders. Is that you can use almost multiple order methods at once. So kind of keeping that previous example going, where you want to sell at $35, you could set a stop 35, limit 30 order. And what you're doing there is you're utilizing a stop limit order. And what that does is once the price of the stock drops to $35, the order is activated and the sell limit at 30 that you'll put in place is more likely to be executed because there's sort of like a bigger range at which the stock price can drop to, which you're willing to sell. So I thought it was just pretty interesting, an interesting way of utilizing both, stop order at a limit order. And it can be done in so many scenarios. Like, you can use a good till canceled stop limit order. And there's just many different ways of sort of mitigating those small risks in the market. And also just sort of like stacking up orders. I found it to be a pretty interesting concept. And I think for retail investors, it's something that doesn't get talked too much about in the actual trading of the stocks that's done.
Yeah, no, that's a really good point. There's so many different ways of kind of entering and exiting the market. Um, and I think the great thing about it is that there's really like no right answer. There's no perfect way to do it. I probably change it up every time for myself. Depending on the stock, depending on, how liquid it is or anything like that. I'll shift between limit and market. Um, but one thing that I've heard was to buy with a limit order and then sell with a market order. So essentially, when you want to sell, you just want to get out of the position, whether you're selling at a loss or at a gain. You just want to get liquidity, so sell at the market. But when you're buying, you want to be a little bit more patient about it and use that limit order. So that's one piece of advice that I read a long time ago. But like I said, yeah, kind of everyone does it differently. So yeah, really,
Yeah,
really interesting though to learn about those different order types. Yeah.
yeah. I think that makes a lot of sense with buying because typically you have like a lower price that you want to pay, but then selling, you may not want to just throw a market order out there. But it does make sense that if you want to sell, you'll probably just want to get rid of the stock immediately, right?
Right, right. So yeah, and then that's on different order types. And I kind of have I guess we'll call it like an investment education piece here. I think a lot of investors, particularly in Canada, are probably looking at the three main registered accounts that we have. So it's TFSA, RRSP, and FHSA, so First Home Savings Account. And so a lot of investors are probably looking at these three and saying, which one should I prioritize? Is there a difference between them? And so really in this, I just want to briefly go over kind of the main differences between them, but mostly about, which one investors should prioritize or focus on for contributions in different parts of their lives and kind of different stages of their lives. So the way I'm phrasing it and framing it is kind of by using like a mental flow chart, I guess. So really, if an investor's primary and most immediate financial goal is just to be a homeowner, to home ownership, then really it's important to just focus on that FHSA because the FHSA provides benefits of both the RSP and TFSA. So investors are receiving tax credits based on contributions to the first home savings account, and they're also getting the benefits of those. So they're getting the benefits of the tax deductible contributions similar to an RSP, but they're also getting the withdrawal being tax free when they make that house purchase. So that's how it's combining both the benefits from the RSP and TFSA. Um, so yeah, if an investor is looking at home ownership, FHSA kind of combines the best of both worlds from our registered accounts. And then, looking at RSP and TFSA between those two, if investors are thinking, where should I allocate my capital? The decision is really between, does an investor want to be taxed now or later? So if one believes that their tax brackets will be, higher in the future, then it's probably worth contributing to a TFSA today. And if they believe that their tax bracket's going to be lower in the future, it's best to prioritize contributions to an RSP. And I'll kind of go into the reasons why for those two scenarios here. So if an individual believes that at retirement their earnings will be lower than they are today, this is mostly for individuals that are like in the middle of their careers, they're close to peak earnings. It makes more sense to contribute to the RSP. And this is because that RSP account offers tax deductible contributions, which are better to use at higher tax brackets. So, if someone believes that they're making more money today than they will when they retire in, let's say, 20 years or so, they're going to receive those tax credits at their higher tax bracket today. And then when they retire at the lower taxable income, they'll be taking out those withdrawals and getting taxed at a lower bracket. On the other hand, if an individual believes that their income at retirement will be higher than it is today, and really this is most applicable for young investors that are early in their careers, they haven't seen peak earnings yet. It's really most efficient to contribute to a TFSA, and this is because with the TFSA, the withdrawals are tax-free, but unlike an RSP, the contributions are not tax-free, and that's because we're taxed on our incomes, and then we contribute those after-tax dollars to the TFSA, and so they're considered taxed in that sense. And so really, if someone believes that their income is going to be higher at retirement than today, They want the tax hit to be today at that lower tax bracket rather than when they retire and have to pull from those that TFSA or the account if it's an RSP and get taxed on those RSP withdrawals. Um, so that's kind of the mental model for how to think about like which account is best for contributions. So really, in conclusion, if one's focused on a house purchase, FHSA is the way to go. That's probably the best source of contributions. If they believe that their tax bracket is going to be higher by the time they retire, contributions to a TFSA makes sense. And if they believe that their income will be lower by the time they retire, contributing to an RSP makes the most sense.
Yeah, that's awesome, Chris. I think the that mental model you put out was really good in terms of, thinking about, okay, when am I going to earn the most, and then picking the correct account to sort of maximize the tax savings, right?
Right. Yeah. And yeah, again, there's really no right or wrong answer. I mean, contributing to both is fine, or all three for some individuals. But if we're talking strictly, how to maximize dollars and after-tax dollars, that's kind of the mental model there. So next, we're going into recent earnings. So this is a good one because we're kind of like right in the thick of earnings season. We're seeing lots of mega cap tech stocks report earnings. um, the Fed just announced their interest rate decision. It's a really big week for the financial markets. And so, with that said, Zach, do you want to start us off with your recent earnings here?
Yeah, love to. So I did and focused in on the AMD earnings, and base level they look like pretty solid. Revenue came in at 6.2 billion, which was 10.7% year over year increase, and also beat analyst estimates of 6.13 billion. So pretty nice beat there. EPS came in right at forecast levels of 77 cents. So again, pretty nice. Coming in right on forecast is again solid thing. On a year over year basis, EPS increased by 12%, so good growth. But the interesting thing with the AMD earnings was that pre-market, the stock was down, I think about 4 or 5%, and I think a big reason for that was with the guidance. So despite the revenue beat and the EPS coming in at forecast, the market seemed not totally happy. But in their guidance, they said that for Q1 of 2024, they would get revenue in the 5.1 to 5.7 billion dollar range, and analysts' consensus estimate there was 5.75 billion. So uh, it was down, I think, about 4%. And I think the main reason there is because of the weaker guidance than expected for Q1. And their CEO, Lisa Su, said that in the quarter specifically, sales of AMD Instinct graphic processors and EPYC server processors drove their fourth quarter revenue beat, while she also noted that higher sales of the AMD Ryzen PC processors were there. So I think Q4 was good, but then looking a little bit more at the guidance for Q1, AMD expects in its data center segment to be flat sequentially in the first quarter. So that may be just like a seasonal thing that they have where the data center segment, sees lower sales in that first quarter, and it sees a strong ramp of data center graphic processing units offsetting a seasonal decline in server sales. And then they also predicted sequential sale declines in its client, embedded, and gaming segments, and also sees revenue from semi-custom chips declining by a significant double-digit percentage. So I would say the main reason for the slip in the market price would be due to the slightly, I don't want to say weaker guidance because they're still forecasting decent revenue growth, but below consensus
Mhm.
guidance, which would be why it slipped a little bit.
Interesting. Yeah, it's a bit of an outlier within the semi space recently, just with everything else kind of popping off and going much higher, like Taiwan Semiconductor, Nvidia, things like that, and we've seen SMCI report earnings and really knock that out of the park. Um, But like you said, yeah, down 4% to start, and really it's only down like 2% right now. So not too bad after all, and especially on a weak market day. So that's not a bad reaction to earnings, and like you said, it was guidance wasn't actually too horrible. So yeah.
Yeah, yeah, definitely. And I think just from a valuation point as well, in the last few months, it's just been sort of soaring in terms of price. The PD's at 43 times now, so maybe that coming down a bit could, serve as like a bit better reaction for the market there.
Yeah, yeah, definitely. Yeah, and I've always thought that with AMD, it kind of has, it's coming at that lower market share, less dominance than, say an Nvidia. And so I think it has a lot of like room to grow in that area. And the CEOs even talked about that is they have all this market share to kind of take, and not much to give back at this point. So it really does seem like, they have, a lot of like upside potential from that market share growth kind of perspective.
Totally, totally. Agreed.
Nice. Yeah, no, that's great. Yeah, so that's a good name, and that's a name that's really recovered well over the past year or so. So really good to see that, recovery, and there's lots of investors that own that, and maybe some sold, but for those that held on, kudos to you. So yeah, that's been a ride, that's for sure. Cool. Yeah. So I'll go through my recent earnings here. So one of the mega cap tech stocks, Microsoft, reported yesterday after hours. They beat across both earnings and revenue estimates, and their Azure numbers were beating the street estimates by about 2.5%. And what we're seeing is AI is beginning to drive cloud strength, and use cases are accelerating demand for Microsoft. Really, we're seeing revenue in intelligent cloud. It grew about 20% year over year, and this was driven by Azure and other cloud services revenue growth. So we saw the revenue growth in those segments about 30% versus 27.5% estimated. So really strong growth numbers coming from Azure and its cloud services. And I'm just going to put up a chart right now on the screen here. So this is a chart of Microsoft's commercial cloud revenue over time, on a quarterly basis dating back to 2017. And we can just see this really nice ramp up in revenue for its cloud-based services. So just an impressive chart that's showing really consistent revenue. Um, and this is kind of, cloud was kind of the future of computing at one point. And now with this next few comments here, we'll kind of talk about like the future of computing from here. Um, so on the earnings in the press release yesterday, I noticed this really interesting comment from the CEO, Satya Nadella, who said, "The next major wave of computing is being born as the Microsoft Cloud turns the world's most advanced AI models into a new computing platform." So this statement really demonstrates like why investors have been so focused on cloud revenues for all of these mega cap names recently. Um, he's suggesting that the next wave of computing is really coming from all of these AI models syncing up, being integrated into their tech stack, and really helping to drive growth in cloud. And so that's why we're seeing cloud growth accelerate here, and why investors have been so focused on cloud strength across these mega cap names. And then another interesting comment from Sadia here is he says, "We've moved from talking about AI to applying AI at scale." I found this comment super interesting because, last year with NVIDIA going significantly higher on, sales of its chips, and we saw ChatGPT be released, and retail users were able to access that and just kind of instantly play around with it. Um, at first, it was just this platform that people could play around with. Maybe they could write or develop a speech for like their friend's wedding or whatever. But now we're seeing enterprises, really start to work on business models centered around AI, using OpenAI's tech stack and its models. And that all is just driving cloud strength across Microsoft. So really interesting comments from the CEO there. And I think it's true that we're now seeing like AI be applied at scale. People are starting to use it in their daily lives, their work lives. And then we're just seeing like businesses at the higher levels, deploy different services using AI. So really fascinating time, interesting times that we live in. So um, that 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 really stood out to me for Microsoft. So yeah.
Yeah, that's awesome. I love that chart you put up. Such a like clean upward trend that has going on there.
Right. Yeah.
Yeah. But it sounds
Yeah.
like the CEO's comments were super, super positive, and then, you see the stock dropping today. Is that just a general market thing or
Yeah. Yeah. It's a good question. I mean, like, it was an amazing earnings release. It was a really good, earnings call and guidance and everything. But yeah, we saw the stock drop. It's down about 1.5%. And we see that happen sometimes when, you know, uh, good earnings, good results are being priced into stocks going into earnings results. Um, so in order for Microsoft to even go up today, it would have had to significantly be even above and beyond what it did. And that's usually what we see happen when these stocks drop a little bit, but usually it's nothing to be concerned about. And these stocks recover from it. 1.5% is not too bad. And so yeah, investors can kind of uh, overall breathe a sigh of relief that the stock is doing well, the company's doing well, and
yeah.
yeah,
Yeah, I
and
feel like it might
overall,
be. Yeah, sorry, go ahead.
oh no, go ahead. I wasn't gonna say anything, so
Okay. I was just gonna say, I
yeah,
think people might be sort of getting into the stocks before the earnings, like you said, um, on the hope that some like crazy jump that's gonna happen after. But even when they come out and they have good earnings like Microsoft did, uh,
right,
people start to sell off. Yeah.
yeah, yeah. It's a really interesting trend. Like I noticed it with Nvidia's earnings last time. Last quarter they reported earnings. Everyone was anticipating some sort of pop higher afterwards, thinking that they would knock it out of the park. Stock would move materially higher after the results. But we didn't see that. We saw the stock drop maybe 5% the next day. And then it just kind of chopped sideways for like a month or two. And it really showed you that everyone was kind of already piled into the name, expecting good results. Good results came out as expected. And so, it was kind of like a brief sell the news event. But it was a really positive report because it showed, fundamentals expanding. Its valuation was contracting. It came down significantly and the stock was just going sideways. And it, really didn't go anywhere for about 6 months. And sometimes when you see that with stocks that have expanding fundamentals, contracting valuation, and their stock price is going sideways, it means it's consolidating and likely it could break out at some point and move higher. So it's all about, distributing the stock from different investors' hands, reaccumulating into others, and then eventually enough demand meets constrained supply and the stock price actually goes up.
Yeah, for sure. So you think Microsoft could see a bit of that trend now?
Yeah, I think it's possible. I mean, it looks like yeah, it had a really strong run. We saw tech names overall have just had like a really strong start to the year, and I think a bit of a pullback is probably is possible here, but I'd still be a buyer of tech names, particularly mega caps. Um, Valuations are maybe on the historically high end, but I I don't think that will stop most investors from buying. And I think that these companies are just growing their fundamentals so much, and we still have lots of upside surprises left in the year. I mean, last year we had the AI surprise, which kind of really brought earnings up in a meaningful way, and we just never know what's going to happen right now. But the tailwinds are there, the industry tailwinds are there, the macro landscape is set up for equities to move higher, and so I think businesses can just do well from here and really surprise investors to the upside. So I I uh, I like I like these stocks momentums and I like these stock names. So yeah, certainly. Yeah.
Definitely. Okay, so Microsoft's a buy.
Yeah.
We're on to the market catalyst now for 2024. Did you want to start off here?
Sure, yeah, let's do it. So market catalyst for the year. So Zach and I are kind of talking about, one major catalyst each that we think can bring the market higher and into this year. So I'll start with my catalyst. So my main catalyst for this year is breadth expansion. So breadth expansion, it's really the market broadening out. We've seen it broaden out recently, but we still haven't seen a few things happen like the equal weight S&P 500. That's the RSP ETF. It hasn't hit an all-time high yet, whereas the S&P 500 has, and neither has the equal weight Nasdaq, which is it's QQQE is the ETF there. Also, the TSX hasn't hit an all-time high and it's about 5% away right now, which may come as a surprise to most investors. It's been sideways for so long, but we're only 5% away, so pretty impressive. But that's really my main catalyst, and so really we're gonna likely see earnings broaden out. We're gonna see investor risk appetite broaden out. I think investors are going to start buying stocks that aren't just the mega caps, aren't just the safe plays, the companies with lots of cash, things like that. I think they're going to go into areas that are typically seen as high growth or more cyclical, and I think those areas are really going to benefit. And I think we're also going to see valuations broaden out. So a lot of these mega cap tech names, their valuations are pretty elevated, but with small caps, they're still at depressed valuations. And lots of other names are at really attractive levels, but the market's still uncertain with rates being so high, inflation still being somewhat at levels that are above trend or above the preferred rate. And so I think that we're going to see, as risk appetite increases, see these valuations broaden out and also a little bit of a broadening out into different sectors. So kind of talking specifically about the TSX, um, I think that the TSX is going to broaden out this year. And, really the TSX, about half of it is actually made up of energy and financials. So, you know, it's kind of wild to think about, but yeah, just about 50% of that whole index for the Canadian markets really is just comprised from energy and financial companies. And the top 20 names in the TSX index make up just over half of the total index. So here I have a table that I've created. Um, and so we see these are the top 20 names by weighting within the TSX index. And it's filtered by highest return over the past roughly year to the lowest return. And then we have a column for weighting, so individual weight, how much they're weighted for the index. And then I've grouped in different weights for the index. And the last column we have percentage to all-time high. So this is how much each stock needs to move higher in order to reach its all-time high. Um, and then there's a couple line items. One is top 20 TSX. So we can see 21% there. That means it's gained on an equal weighted basis 21% over the past year. So that means the top 20 names of the TSX have done pretty well over the past year. Then we look at the TSX index as a whole, and we see it gained about 13% over the past year, so much lower. And really, what I'm looking at is specifically these lower names on this list. We can see they have the highest percentage to all-time high, in this double-digit range, like 10%, 20%, and so on and so forth. And so my expectation, my catalyst for the year is really that these these names that have significant moves higher till their all-time highs. I think that investors will start looking at these names, and there could be many different catalysts for why those names move higher. But I think those names will start to increase in value, and that will just help lift the overall TSX sector, the TSX index. And so when we look at these names, it's, TRP, BNS, Scotiabank, we talked about them in our reports, TD Bank, BCE, Enbridge. And so really the common theme between all these names is energy and financials. So I think if we see energy and financials start to improve and increase in value this year, whether it's from, the credit markets, the capital markets, interest rates falling, one of those areas is going to improve. And I think that will really help both energy and financials. And then just mathematically, that will help the TSX as a whole move higher. So that's kind of my main catalyst for the year. Of course, it's a prediction, but that's kind of my thinking here.
Yeah, so my catalyst is that we're going to see a pickup in the M&A market, and we're going to see an increase in both deal volume and deal value compared to 2023. So I think it's been pretty widely documented that M&A activity was down in 2023 on both a volume and value basis, and both pretty significantly. And that was largely due to just the macro environment, with high and rising interest rates and inflation also being high, and then widespread fears of recession. And then there was other outside factors like geopolitical challenges, which could still continue, but I think hopefully there won't be anything new on that front. So I think more so the macro environment improving is going to help M&A activity really jump up. And another sort of aspect of that, which is more like my speculative take here, is that a lot of companies were preparing for recession in 2023, and maybe they held on to a bit more cash in sort of getting ready and bracing for those impacts. But with going into this year, if we have, even a smaller recession than what was anticipated, these companies will find themselves with a lot of cash that they could potentially deploy into, you know, acquisitions and mergers that they had in their pipeline that they wouldn't have wanted to pursue in 2023 because of how tough of a financing environment it would have been. So I think we can see that, and particularly in sectors like energy, TMT, and pharma. And those are historically some of the strongest M&A driven industries. And all of them will benefit from, I think, the newer market conditions. And if we look into those industries respectively, TMT has sort of the trend going on with AI, and that's likely to be long term. And I think we could see some acquisitions coming from that. Then, in terms of the energy industry, we have energy transition and sustainability focuses, which have been around for a few years now. But I think that could be another area where companies have had projects or other acquisition related activities in their pipeline that they can move on. And of course, in healthcare, the rise of weight loss drugs, that just creates an opportunity that could also happen. So I think there's sort of the macro environment's improving, and then there's individual industry trends that are sort of rose up in 2023 that maybe companies weren't able to totally act on. And yeah, I think it's going to be an interesting environment there, and we can see some bigger players making more moves.
Yeah, no, definitely. That's a great catalyst. I like that a lot because you're right. Like we didn't see much M&A activity going on in 2023 or 2022, and so it is quite likely that we start to see that pick up again, especially as rates start to at least stagnate or come down, and businesses feel a little bit more comfortable about deploying those levels of cash or taking on some debt, looking at the cost of debt. So that's a really good catalyst. I like it. I think it makes sense with a lot of these companies being cheap. You know, everyone's going to start looking for, hey, what's the next way that we can grow? Maybe it's by acquisition. And look, there's so many cheap companies out here. So yeah, that's solid. I like that. I like that idea a lot.
Yeah, yeah, and I think it's not also necessarily that the interest rates need to come down. I think they just need to stable out as well, like you mentioned there. It doesn't need to be some big like drop or multiple drops like people want, but even if it's just like an environment that they can say they know what they're getting themselves into a bit more will be helpful for M&A.
Yeah, yeah, definitely. Yeah, just some sort of predictability with financing. Makes sense.
Yeah, for
Cool.
sure.
No, that's awesome. I think we're onto something here. I like it, and I think that we'll start to see some of that play out throughout the year. So yeah, I definitely agree with that. Cool. All right. Well, I think that's all that we have for today. So we've kind of covered all of the sections for today. Um, we hope that you enjoyed this episode of our podcast and learned something new about the Canadian markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and we'll see you next time.
1.